Welcome to today's deep dive. Today we're unpacking a company that quietly runs the entire back end of the artificial intelligence boom.
Very quietly.
Right, exactly. Broadcom, ticker symbol AVGO. And to figure out if it's actually a smart investment for you right now, we've got a pretty substantial stack of financial reporting to get through.
A massive stack.
Yeah, it really is. We're pulling insights from recent articles in 2047 Wall Street, The Street, The Chronicle Journal, plus some deeply researched historical presentations from the Notre Dame Investment Club, and, just a wealth of current market data.
Which is great because it paints a picture of a business that is often misunderstood.
Yeah.
Or at least totally underappreciated by the casual observer.
Because they're not consumer-facing.
Exactly. People are looking at the flashy side of technology, the stuff you and I hold in our hands, not the plumbing.
And that's the perfect setup, because the statistic that hooked me immediately upon opening these files has absolutely nothing to do with consumer gadgets. Broadcom just posted a record earnings report, and in a single quarter, they returned nearly $11 billion to shareholders.
It's just staggering.
$11 billion in one quarter.
Right. Which, it forces us to ask a very important question. Because when people think of the AI revolution, they immediately think of chatbots, right?
Yeah, ChatGPT and all that.
Or they think of the companies making the actual graphics processing units, the GPUs. But Broadcom is different. They are the hidden architect of the back end.
The plumbing.
The incredibly complex plumbing, yes. So the fundamental question we need to explore for you listening today is this. Amidst some recent turbulence and pullbacks in Broadcom's stock price, is Wall Street missing the real story?
Let's start by breaking down the business landscape, because to understand if the stock is a buy, you have to understand what you're actually buying.
Always a good idea.
Looking at their business model, it's divided into two main buckets. About 80% of their business is semiconductor solutions.
And the remaining 20% is infrastructure software.
Right. So that 80% semiconductor side, that's the engine, especially for AI.
Oh, absolutely. But to really grasp why they are so dominant in that space, we need to think about how modern data centers actually operate. It is not just a big, cold room full of computers.
I want to bring up that analogy we discussed earlier before we started recording, because I think it clarifies this beautifully for the listener.
The sports car one.
Yeah, the sports cars. If the AI GPUs, like the really famous ones made by NVIDIA, if those are these incredibly fast, high-performance sports cars, then Broadcom is the company building the high-speed superhighways.
And the traffic control system.
Right, the traffic lights, the routing, everything that allows those cars to actually race without crashing into each other.
That visual is just spot on.
Yeah.
Because a single GPU, I don't care how powerful it is, it cannot train a sophisticated AI model on its own. It's impossible.
You need a whole fleet of them.
You need tens of thousands of them working together seamlessly. And they generate a staggering amount of data that needs to move between them in microseconds. Broadcom provides the high-speed Ethernet switches and what are called ASICs.
ASICs, application-specific integrated circuits.
That's right.
And an ASIC is basically custom-built silicon designed for one very specific job rather than a general-purpose chip.
Correct. Precisely. This custom silicon acts as the nervous system connecting all those separate chips so they can function as one single unified supercomputer.
So without Broadcom, the GPUs are useless.
Well, without Broadcom's networking technology routing the data efficiently, all those expensive GPUs would just be sitting in a digital traffic jam. They'd be starved for information. Basically, they'd be extremely expensive space heaters.
I love that, expensive space heaters. So who is actually buying these superhighways from Broadcom? Here is where the concept of an economic moat becomes very real for you as an investor.
Oh, the moat is massive.
Right. According to the data from the Notre Dame Investment Club presentation, Broadcom has an intensely concentrated customer base. Their top 5 customers account for 35% of their net revenue.
45%.
Yeah.
And we're not talking about small regional businesses here. These, the hyperscalers.
The big guys.
The biggest. Companies like Google, Meta, Microsoft. Now, conventional investing wisdom usually says customer concentration is a major risk.
Because if you lose one of those 5, your revenue completely tanks.
Exactly. You lose 20% of your business overnight. But the reason this intense concentration is actually a sweeping strength for Broadcom comes down to how these products are built. Broadcom engages in what the industry calls deep design win cycles.
Meaning they aren't just selling a generic network switch out of a catalog?
Far from it. They are co-designing this custom silicon with a company like Google over a period of several years.
I want to linger on that for a second to really emphasize the switching costs for you. If Google spends 3 years co-designing a custom chip with Broadcom,
Which costs a fortune in R&D.
right, and then they integrate it into a $5 billion data center, switching to a competitor later isn't just buying a different part from a catalog.
No, it means completely rewriting your entire software stack,
Yeah.
changing the physical cooling infrastructure, risking billions in downtime.
It's essentially a marriage, not a transaction.
That is the perfect way to frame it. The cost and the technical headache of switching to a competitor would just be astronomical. That dynamic creates an almost impenetrable economic moat around Broadcom's semiconductor business.
But the twist, and I find this fascinating about their supply chain, is that while they're doing all this complex, high-margin internal design work, they outsource almost all the heavy lifting of the actual manufacturing.
They do. They operate what's called a fabless model.
The sources note that about 90% of their wafer production is handled by outside foundries, companies like TSMC and Foxconn.
They aren't bogged down spending tens of billions running the physical factories themselves. They focus strictly on the high-margin design and the software side.
Which is a brilliant segue into how this company is actually managed day to day. You simply cannot talk about Broadcom without talking about its president and CEO, Hock Tan.
No, you can't. He is the architect of the whole thing.
He took over way back when AVGO spun off from Agilent in 2005, and his playbook is widely studied in business schools right now.
Yeah, good reason.
It's built on aggressive, highly strategic M&A, mergers and acquisitions. Over the years, he's purchased companies like LSI, Brocade, CA Technologies, Symantec, and of course, the mammoth $69 billion acquisition of VMware.
And if you look closely at that list of acquisitions over time, you'll notice a very deliberate shift in his strategy.
Right, moving away from hardware.
Well, he started by consolidating the hardware and semiconductor space, buying up smaller chip and networking companies. But the recent moves, specifically CA Technologies, Symantec, and VMware, that represents a distinct pivot towards software.
I want to push back on that pivot for a second. Why does a semiconductor company suddenly decide to buy a mainframe software company like CA Tech or an enterprise cybersecurity firm like Symantec?
It seems random, right?
On the surface, it looks like a CEO just empire building, just buying things to get bigger.
It looks completely disconnected until you look at the customer list. Hock Tan realized that the top 500 global enterprises buying his networking hardware were the exact same companies buying mainframe software and cybersecurity software.
Oh, wow.
Yeah. So these are not random snap-on deals just to boost top-line revenue. They are what the financial world calls accretive software expansion. He is buying software products that he can cross-sell to his existing locked-in hardware customers.
Which increases the value of the company immediately.
Instantly. And Tan has a very specific, almost ruthless financial formula he applies to every single deal to make sure it pays off.
He's legendary for it on Wall Street. The management objectives outlined in our materials highlight a relentless focus on streamlining operations.
Relentless is the word.
He buys a company, strips out any experimental research and development that isn't driving immediate revenue, focuses entirely on the core products, and aggressively cuts costs.
And the sources mention his proven history of rapid deleveraging.
Let's translate that for the listener really quick. When Broadcom borrows tens of billions of dollars to buy a company like VMware, they take on a mountain of debt. Deleveraging is just the process of paying that debt down quickly.
Right. And Tan targets a return to a 2.5x debt-to-EBITDA ratio within just 2 years of an acquisition.
2 years? That's incredibly fast for that much debt.
It is. And EBITDA, for those who might not live in financial spreadsheets every day, stands for earnings before interest, taxes, depreciation, and amortization. You can think of it as the raw cash engine of the business before accountants start applying tax rules and non-cash deductions.
It's the real money coming in the door.
Exactly. And Tan's ability to maximize that raw cash flow to pay down debt is historically unmatched. The data shows Broadcom achieving a 16.6% return on invested capital, compared to a competitor average of just 9.5%.
So they are nearly twice as efficient with their capital as their rivals.
Yes. That efficiency is a huge competitive advantage. But Tan's agility isn't just financial, it's also geopolitical.
Okay, yes. Now, just to be crystal clear for you listening, we are looking at this next event purely through the lens of corporate strategy. We are not taking any political stance on national security or international trade.
Just looking at the business facts?
Purely as a business pivot, TAN's reaction to a major regulatory roadblock in 2018 is a fascinating case study.
It really is. In 2018, Broadcom attempted an enormous $117 billion hostile takeover of a rival chipmaker, Qualcomm.
$117 billion.
Massive.
Wow.
But the deal was formally blocked by the federal government over U.S. national security concerns. The stock took an immediate 13.4% hit.
Having a deal of that magnitude blocked by the government usually tanks a company's momentum for years. How did TAN not completely lose the plot there?
Because he didn't fight a losing battle. He adapted instantly. He moved Broadcom's headquarters from Singapore to San Jose, California.
He just packed up and moved to the U.S.
Yep. And he began taking his cash flow and heavily investing it into building 3 U.S. manufacturing facilities in Pennsylvania, California, and Colorado.
While still keeping the international ones open, right?
Right, maintaining their 6 international factories to keep global relationships intact. But he essentially onshored a significant portion of the business.
And this move accomplished several strategic goals simultaneously. It built vital confidence with U.S. lawmakers. It diversified their revenue to combat fluctuating international supply chain prices.
And crucially, and this is the genius part, it positioned Broadcom perfectly to capitalize on the 2022 CHIPS and Science Act.
Oh, right.
Which unleashed $280 billion in federal funding to boost domestic semiconductor manufacturing.
The results really speak for themselves. Because of this entire strategic realignment, their gross profit margins didn't just survive the Qualcomm failure. They leaped from 66.3% to 74.3%.
Turning a monumental regulatory failure into an 8% bump in gross margins is just a masterclass in corporate agility.
It really is. And that agility brings us directly to their current financial reality, which is, frankly, hard to wrap your head around without stopping to look at the scale.
The numbers are huge.
Let's get into the numbers from their recent earnings call. This is from their record Q1 fiscal 2026 report. Revenue hit $19.3 billion.
Which is a 29% year-over-year increase.
Huge growth. But the number that really defines Broadcom is the adjusted EBITDA.
$13.1 billion in adjusted EBITDA for the quarter.
Which translates to a 68% margin.
I really want to linger on that for a second so the listener can fully appreciate what a 68% EBITDA margin means.
Most companies would kill for that.
Most robust, highly successful companies would throw a massive party for a 20% margin. Retaining 68 cents of raw operational cash for every single dollar that comes in the door is practically unheard of for a company operating at a $20 billion quarterly scale.
It proves exactly how effectively Hock Tan's cost-cutting and integration playbook is actually working.
And a huge driver of this growth right now is the AI revenue acceleration. This is not a sudden one-quarter spike. The sources from 2047 Walsane show a clear trend. Broadcom has seen 11 consecutive quarters of AI semiconductor growth.
11 straight quarters. And the forward-looking guidance is where it gets truly interesting. Management expects AI revenue to double year over year, hitting over $8 billion for Q1.
Right, and analysts like Harlan Sur at JP Morgan, they project it could actually exceed $9 billion and then run up to the 10 or 11 billion range in Q2.
Just massive scaling.
Looking slightly further out, Wall Street believes Broadcom has a clear line of sight to $100 billion in AI chip revenue by 2027.
$100 billion.
By 2027. That is a completely different stratosphere from where they were even 2 years ago.
With those kinds of projections, it's really no surprise we see the sweeping shareholder returns I mentioned at the very top of the show. Let's unpack the mechanics of this cash machine for a second.
Yeah, let's do it.
Their free cash flow, which is the actual hard cash left over after paying for all operations and capital expenditures, the money they can essentially do whatever they want with. That is projected to grow from $49 billion in fiscal 2026 to an astounding $127 billion by fiscal 2030.
And that mountain of free cash flow is exactly what allowed them to return that $10.9 billion to shareholders in Q1 alone.
Because they don't really have to build factories.
Exactly. The fabless model pays off. So they spent $7.8 billion on share repurchases. which is a tactic where the company buys its own stock off the open market and retires it.
Shrinking the pool of shares.
Right. That reduces the number of outstanding shares, which artificially increases the value and earnings power of all the remaining shares held by everyday investors.
And the remaining $3.1 billion went out as cash dividends. If you're an income-focused investor listening to this, someone who looks for reliable quarterly payouts, the dividend growth history here is vital.
It's one of the best in tech.
The Street reports that Broadcom has increased its annual dividend at a rate of over 30% annually since 2016. It's grown from just 18 cents a share a decade ago to $2.60 per share today. On an annualized basis, Broadcom is paying out over $12 billion in dividends every single year.
And with their projected free cash flow growth, analysts note that even if Broadcom maintains a very conservative payout ratio of just 20% of their cash, that annual dividend could double again over the next 4 years.
Which is wild for a tech growth stock.
It's extremely rare. Finding a single stock offering the explosive secular growth of the AI hardware sector paired with the stable, monumental dividend yield of a legacy utility company. It just doesn't happen often.
Okay, so the business model is a juggernaut. The leadership is battle-tested. The cash flow is historic. But you're probably wondering, what about the stock itself? Is it actually a good investment today based on its current price and valuation?
Right, because price matters.
Let's look at the recent market action. To contextualize the current price, we have to note that in July 2024, Broadcom executed a 10-for-1 stock split.
They essentially cut the pizza into more slices.
Exactly, to lower the price of a single share, primarily to increase accessibility for everyday retail investors.
And after that split, the stock went on an absolute tear. It hit highs of $417 in late 2025.
But recently, it has seen some real turbulence. It's
Yeah.
currently trading around $314. That's a roughly 25% drop from its recent peak, though it did just pop 8% on March 5th, right after they announced that massive Q1 earnings beat.
This creates a highly debated scenario on Wall Street right now. Shares are currently trading significantly below their recent highs. So what do the professionals think?
Well, synthesizing the views of the analysts covering this across our source materials, there are 48 strong buy ratings.
48.
Let me guess, a handful of holds and a few analysts saying it's overvalued and time to sell.
Actually, 0. There are 0 sell ratings among tracked analysts. The consensus 12-month price target is sitting between $454 and $461. That implies a roughly 40% upside from where it sits after this recent dip. Jim Cramer went on the record right after the earnings release, explicitly calling it an undervalued stock, full stop.
I have to play devil's advocate here, though. If 48 professional analysts say it's a screaming buy and literally no one says sell, isn't that a crowded trade? Why did it drop 25% in the first place if everything is so flawless?
That is exactly the right question to ask. The pullback comes down to valuation multiples and perceived risks regarding their margins. Right now, the stock trades at a forward price-to-earnings ratio, or forward PE, of about 25.
Let's translate that for everyone. In plain English, investors are willing to pay $25 today for every $1 of earnings Broadcom is expected to generate next year.
Correct. The bullish argument is that 25 times forward earnings is actually cheap because the broader market is actively discounting the sheer scale of the AI revenue acceleration that Broadcom has already quantified in their guidance.
But there are cautious analysts, too.
Right. Analysts who are cautious point to a primary underlying risk-gross margin compression.
How exactly do their margins compress if they're generating record revenue?
It is about the product mix. As Broadcom sells more of their advanced computing processors, their custom XPUs for AI workloads, those specific, highly complex sales naturally carry slightly lower profit margins than some of their older legacy networking products.
Ah, I see.
The fear in the market is that as AI hardware becomes a much larger overall percentage of their revenue pie, their overall corporate gross margins might slightly shrink. In a market that scrutinizes every single decimal point, any fear of shrinking margins or any slight miss on future AI revenue guidance could cause the stock to draw down further.
So the risk is that they're almost victims of their own success in the AI space. But the general consensus across all our sources seems to be that the underlying growth engine is simply too powerful to ignore.
Yeah, the Chronicle Journal described Broadcom as the blue-chip AI play.
For you as an investor, it's viewed as a strategic way to get on the entire build-out of artificial intelligence infrastructure without gambling on the success of just one single tech giant.
It offers significantly less volatility than a pure hardware play like NVIDIA, but it offers much higher growth than traditional legacy tech stalwarts like Cisco.
I often think of it as investing in the toll road rather than trying to pick the fastest car driving on it.
That's a great way to look at it.
Yeah.
Because no matter which hyperscaler wins the AI arms race, whether it's Google's models or Meta's or Microsoft's, they all have to pay the toll to Broadcom for the networking infrastructure and custom silicon required to make their data centers function.
So to summarize the core takeaways for you today, Broadcom is a highly disciplined, ruthlessly efficient cash generator. They have constructed an almost impenetrable moat in the AI networking space through deep, multi-year design cycles that lock in the biggest customers on Earth.
And they offer this exceedingly rare combination of explosive AI hardware growth paired with a vast, rapidly increasing dividend yield.
Right. And Hock Tan has proven time and again that he can navigate regulatory minefields and execute enormous software acquisitions to protect the bottom line and keep the cash flowing.
It is a highly compelling investment thesis. But as we always aim to do, we want to leave you with something to ponder on your own, something beyond the immediate quarterly numbers.
We have established that Broadcom relies heavily on these deep design cycles with the biggest tech hyperscalers, who are currently engaged in a historic, unprecedented build-out of AI data centers.
The superhighways are under construction everywhere.
They really are. But this raises a critical question for the long-term horizon. What happens if, or realistically when, this colossal cycle of upfront AI infrastructure spending finally normalizes or begins to slow down?
Because it has to eventually.
Right. When the physical data centers are largely built and the hyperscalers inevitably pull back on their capital expenditures, will Broadcom's aggressive pivot towards software through those acquisitions like VMware and Symantec be enough to bridge that revenue gap?
Will the software side of the house be robust enough to keep this incredible cash machine running at its current record-breaking pace when the hardware cycle cools off?
That is the multi-billion-dollar question to keep an eye on as this industry evolves. Thank you so much for joining us on this deep dive. Keep questioning the numbers behind the headlines, and we will catch you next time.